Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull. Thanks for being with us today. Well, today their topic is the office market. You know, the U.S. office market has been hot. Depending on where you are, that you might even see new construction. If you're a tenant, maybe you're seeing some rising rates. Well, let's talk to Walter Page. He's Director of Research with the CoStar Group and see how the market's doing. Walter, thanks for joining us today.
Thank you.
We appreciate it. Now, Walter, how has the U.S. office market performed year to date? What do you see?
Well, Michael, the office market fundamentals continue to improve in the third quarter. Current vacancy rate is 11.6%. That's down from 12.1% a year ago. To put some perspective on this national vacancy rate has fallen for more than 4 years in a row and is now really close to the 2005 levels and the long-term averages. Rents have expanded by 3.6% over the past year. Free rent concessions have generally come in. That compares to 2.6% rent growth a year earlier, so clearly an upswing on rents too. Driving the improvement in fundamentals was a solid string of net absorption. We had 23 million square feet of positive net absorption in the past quarter and 77 million square feet over the past year. This is the highest four-quarter level so far in this recovery, and it represents a growth in demand of 1.1%.
That's very impressive numbers. I mean, did you expect the numbers to be this strong right now?
Actually, the market is tracking exactly where we thought it would, and this is principally because the job numbers are a little bit slow, but we thought they'd be slow, and we expected that the market would start to pick up. Shadow supply is diminishing and things like that.
Okay, and is this recovery across all classes and geographies?
So it is. It's a focused recovery. We see three major themes. The first theme, I would say, is that tenants want nice space. So what we're finding is top-tier space, which we define as 4- and 5-star space, or people might call Class A space, has achieved net absorption rates double their fair share. So on the magnitude of 2/3 of demand is going to this nice space, and it only represents 1/3 of the market stock out there. So that's clearly a big thing. The other big theme with this nice space is they want a good location, and that's generally an urban location close in suburban or a CBD locations, because those markets have done exceptionally well in terms of net absorption. So markets like Houston, West Suburban have done well. San Jose's, Cupertino, I call it the Apple effect, has done well. Boston, Cambridge, and even markets like the Dallas CBD. The second big theme that we see is that technology markets, energy markets, and healthcare markets are all leading in the recovery. In particular, San Francisco is the poster child for this because their rents are up by 60% since the recession ended. Houston rents are up by 40%. And then for the healthcare segment, we're finding that medical office vacancy rates or anything medical related tends to have 1 to 2 percentage points lower vacancy rates than the overall market. And then the final theme that we see is that tenants are using less space per job, and this is in particular impacting lower quality space. In fact, we've seen a 15% reduction in typical tenant space usage over the last 12 years. So clearly that is another general theme.
Okay. So what do you expect moving forward for property-level performance in 2015? I mean, these are some pretty strong numbers. Do you expect it to continue?
So given the office demand growth is about 1.1%, but job growth, in particular the office segment, is growing at a 2% rate, we're looking for the net absorption number, which was 77 million square feet this past year, to be over 90 million square feet in 2015. Additionally, we expect office rent growth, which was 3.6% this past year, to continue to be in that 3.5 to 4% range for 2015.
Okay, and we're talking with Walter Page, Director of Research with the CoStar Group. And Walter, let's look at the investment market now. What do you see for cap rates? Where are they trending today in the office market?
So, cap rates peaked at about 8.6% in early 2010. They've declined about 2 percentage points for institutional property and a little over 1% for non-institutional property. Today we see that most of that cap rate decline has happened prior to 2014, with generally stable cap rates over the past 6 months or so.
Interesting. So the Class A rates are down near 6.6.
Yes.
And how about B product? I guess you're getting a better return there. How much higher are those rates, cap rates?
For the non-institutional, closer to 7.4.
Okay, 7.4. Now, what do you expect for cap rates moving forward? Some people are concerned that a rise in interest rates could impact cap rates and values. What do you guys expect to see?
So we think the capital markets have anticipated a rise in interest rates. Mm-hmm. And so we think the pass-through rate from an increase in interest rates should be relatively low. Let's say if you have a 1% rise, you're going to get less than 1/3% increase in cap rates. For investors, this basically means the days of cap rate compression are over, but don't necessarily look for a huge reversal in the cap rate trend either.
Okay. And what might be some tips for investors in the office market today, Walter?
So we think 2015 is a good year to start new construction. We think that because people who start early in the market cycle tend to do better. Mm-hmm. We also like fixing broken real estate. So that means if a building has an occupancy challenge, if it needs a renovation, value-add investing, I think, will do very well going forward, principally because we still see a couple of good years left in the market cycle in terms of occupancy gains.
Okay. And you guys are looking at these numbers all the time, and it's interesting, I guess, what you see sometimes. Is there anything in the trends and in the numbers that jumps out at you that we should think about?
Well, one of the things that jumps out is that the level of in-process construction has increased by 25% over the past year. Mm-hmm. So we now have 100 million square feet underway. In particular, Houston has 18 million square feet. New York has 10 million square feet underway. So clearly the construction pipeline is starting to pick up. But we don't expect the construction deliveries to exceed net absorption until about 2017.
And how about trends with tenants? You talked earlier about tenants using less square footage. And are you talking about them using less square footage per employee or just less square footage overall?
On a per employee basis, we had been seeing about a 2% rate of decline. We see some indications that rate of decline is now slowing to a 1% rate of decline, and it is mainly focused to lower quality space, people who are more price sensitive.
I see. And what do you expect moving forward into 2015 to impact the office market? Is it the economy, is it interest rates, or is it just jobs?
Jobs is the number one driver of real estate demand. As long as we have good job growth, and we do expect to have good job growth, we will have a very solid real estate market. The other thing is that we've already gotten rid of all the excesses from the last recession, so the tailwinds of shadow supply and things like that are gone.
And what do you expect for financing moving forward? Is there readily available financing for the office sector right now? Do you expect that to continue, or can you get a loan to build a new office building today?
There is plenty of capital available for real estate. What we have seen is that the level of pre-leasing required by lenders has gone up. It used to be that you'd have to have 30% pre-leasing. Today, that number is closer to 45% pre-leasing based on our statistics, and it's been that way since the recession ended. And but you still have capital that's available.
Well, that's interesting. So, in that way, I guess the office sector is kind of taking care of itself because there's going to be less new supply if you've got to have those kind of numbers for pre-leasing, right?
Yes, and the other thing is that we're finding that rents just don't justify construction. So we only see construction roughly a third of the major markets. So 2/3 of the major markets have limited construction, and basically investors are waiting for rents to get to a level that they can make sense out of the new construction investment.
Well, that makes sense, and well said, Walter. Thanks for joining us today and sharing your insight. We appreciate you being on.
Thank you.
If you'd like more from CoStar, visit CoStar. They have incredible information on the office market across the U.S. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Brokerage, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive suite of powerful commercial real estate tools at an incredibly low price. Visit realnex.com. That's RealNex. Sozo Web Hosting and Cloud Solutions. Secure, reliable, and worry-free. Visit sozo.com. That's SOZO.com. FIU, Florida International University. Earn your master's in real estate online in as little as 10 months. Visit FIUonline.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. For more information on these great companies or for additional podcasts, videos, or blogs, visit creshow.com.